When an investor invests in a stock, the primary reason they do so is to ensure that they will have a return on their investment. Now, their return on investment can come in a couple different ways. One, they can get a return on investment at the time they sell their stock. The other way to get a return on their investment and maintain the ownership within the company is to either receive a dividend or a stock split. When we talk about dividends, we're talking about a distribution of the retained earnings to the stockholders. Now, that distribution to the stockholders is on a pro rata basis based upon a specific point in time. Now, that dividend can be in the form of cash, in terms of management declaring a cash dividend to its owners of record at a specific date. If the company does not have enough cash to provide a cash dividends to its stockholders, they may elect to do a non-cash dividend, such as a distribution of property or the distribution of additional shares of stock in the form of a stock dividend. The last way that they may issue a dividend is to promise to pay cash to the stockholders when cash is available in the form of a promissory note. Cash dividends is typically the most common way of receiving a dividend. We reduce retained earnings and we pay it out in cash to the stockholders. This decision to provide a cash dividend is done by the board of directors. They determine the data declaration, the data record, and the data payment. These are very important because the data declaration and the data payment require us to perform journal entries to record the dividend. The data record has no journal entry requirement. So in essence, what we're looking at is that management says on December 1st, we are going to pay out a dividend. At the time that the dividend has been declared, the company is now obligated to pay out that dividend. So they would immediately reduce the retained earnings and show a dividend payable. The data record is who owns the stock on that specific date. The company determines who the owners are on the data record, and those are the individuals who will receive the dividend. The data payment is when the actual dividends get paid out. In the event of the payout of the dividend, we show the cash being paid out with a credit to cash, and we show that the liability has been reduced because we've paid it off. So here's an example of how we would record journal entries for cash dividends. On December 1st, the directors of Media General declare a 50-cent per share cash dividend on 100,000 shares. The par value of the common stock is $10 per share, and the dividend is payable on January 20th to shareholders of record on December 22nd. Note that we need to make journal entries on the data declaration, the data payment. So on December 1st, when General Media declares that they are going to make a dividend, they are now liable for the dividend. So they do a debit to cash dividends of $50,000 and a credit to dividends payable for $50,000. The cash dividends account is the debit entry to reduce retained earnings when we close the books at the end of the year. On December 22nd, the data record, all we're trying to do is determine who owns the stock on that particular date, because they are the ones that are going to receive the dividend. When we pay out the dividend on January 20th, we would show that we no longer owe for the cash dividend of $50,000 by doing a debit. We would then credit cash for $50,000 to reflect the cash that had been paid out. A stock dividend is a little bit different. Instead of giving out cash, the company gives out stock as a dividend. The result is a decrease in retained earnings and an increase to paid-in capital. Why would a company want to issue a stock dividend? Well, one, they would be able to satisfy the requirements of the stockholders to receive a dividend while they're still able to save the cash for other intended uses. They increase the marketability of the corporation stock because they're allowing to have more shares of stock outstanding. The emphasis that a portion of stockholders' equity has been permanently reinvested in the business shows that the company believes that their stock is a good investment. So the effects of stock dividends, it changes the composition of stockholders' equity. The number of shares of stock outstanding will increase and retained earnings will be decreased. Total stockholders' equity will remain the same since all we are doing is moving monies out of retained earnings into common stock. There's no effect on the par value or the stated value of the stock. However, the number of shares outstanding will increase. So here's an example. Medline Corp declares a 10% stock dividend on its $10 par common stock when there are 50,000 shares outstanding. The market price was $15 per share. So if you note, there were 50,000 shares outstanding at $10 par, which means that common stock had a value before the dividend of $500,000. After the dividend, the common stock will be worth $550,000. But notice what happened to the paid-in capital. Because the market value of the stock was $15 per share, while the common stock was $10 per share par value, there was $5 per share paid-in capital in excess of par value. So therefore, we would pick up an additional $25,000. So the paid-in capital portion of stockholders' equity increases by $75,000. But remember, dividends reduce retained earnings. So if paid-in capital goes up by $75,000, retained earnings has to go down by $75,000. The net effect to stockholders' equity is zero. Another type of return to the investor is called a stock split. Now, stock splits are favorable for investors in many cases because it reduces the market value of the shares. By reducing the market value of the shares, more people will hopefully be willing to buy the stock if the stock was available for sale. Now, that sounds like a bad thing for stockholders, except for that while the market value is decreased in a stock split, the number of shares are going to be increased to the shareholder. So, in a 2-for-1 stock split, for every 1 share of stock that a owner had, they will now receive 2 shares of stock in exchange. So the number of shares of stock will double in a 2-for-1 stock split, but then the par value would decrease in half. So here's an example. Assume instead of issuing a 10% stock dividend, they decide to do a 2-for-1 stock split. The common shares of stock does not change in terms of value, and the retained earnings doesn't change in value. So our stockholders' equity in terms of dollars remains exactly the same. The difference is take a look at the common stock description. Before, the common stock was 50,000 shares at $10 par value, and because of the 2-for-1 stock split, now the number of shares outstanding is 100,000 shares, but the par value has dropped to $5 per share. The difference between the effects of stock dividends and stock splits is here on this screen. You can see where in a stock dividend, the increases and decreases versus a stock split does not change stockholders' equity other than the number of shares outstanding and the par value of the common stock.